Hello everyone, and thank you for watching my videos. Risk management is the difference between life and death of a Forex trader. It is very vital as it keeps us in the market. Now, as I mentioned before, we make our mistakes in the beginning so we don't make our mistakes further down the road. However, if we don't manage our risk properly, then we won't be able to have those opportunities down the road. So we need to know how to manage our risks every time we enter the Forex market. Now, here's what we need to know about risk management. It is the most overlooked area in Forex trading, and we also need to realize this. We want to be an investor, not a gambler. Gambling is making a trade without managing your money. Now, speaking of gambling, let's talk about casinos. Sometimes the casino wins, and sometimes the players win. But we've all heard of the old saying, the house always wins. Well, what that actually means is that the casino always gets its profit, no matter what. You see, the people that build the casinos, they're actually a team of people. We're talking psychologists, we're talking people with PhDs and MBAs from Ivy League schools or MITs. We're talking about expert mathematicians who are able to devise various mathematical formulas to make sure that the casino has the mathematical edge in every game they play. You see, casinos don't have to win every single bet. What they want is to keep the player in the casino long enough so the casino can eventually get back what they've lost. For example, let's say you have a player who wins $10 million on a slot machine. Now, just because that player wins $10 million does not mean that the casino is going to suffer. No, because it's more likely that there were 30 million people who played that slot machine before him, and there will be 30 million people that will play that slot machine after him. So we're talking $60 million into one machine, 10 million coming out, the casino gets a $50 million profit. So you see, that man that just won the $10 million, that was merely an advertisement from the casinos. You see, sometimes casinos want you to win because when you win, that's a form of advertisement for them and more profits from them. So that's what the investors, the expert investors who have analyzed this market for 20, 25, and 30 years, they're thinking with the same mentality. We're not going to win on every single trade. We will lose some, but if we do take a losing trade, how much can we lose and still keep making future investments? So that's what you're thinking. The goal is to be able to last long enough in this market to make future investments, because the more investments we make and the more we learn from our mistakes, the easier it is to make the profits that we can make. So risk management is very important. And also, we need to practice this at all times. So it goes back to my training lectures on discipline, okay? Because the key to being successful risk managers is discipline. Okay, so let's talk about capitalization. Now, here's what we need to know. First, we need to educate yourself. We need to know exactly how much capital we need to have in our accounts so we can know how much we can withstand to lose and how much breathing room we have so we don't get margin called. Also, discipline, as I mentioned before, along with focus and commitment to learning the market, increases the probabilities of success tremendously. So again, we need to practice discipline. We need to stick only to our trading system. We cannot deviate from our trading system or take on someone else's trading system. We trade only by using our trading system. If our trading system is not giving us the profits that we need, then we improve on the trading system, but we only stay within the trading system and we only focus on our trading system. Okay, second, can you trust your broker with charts, platforms, tools, and news feeds provided? So again, we need to make sure that before we enter a relationship with a broker, whether it be online or in person, can we trust that broker? And finally, how much capital can you start with? Because again, we need to have a certain amount of disposable capital that we can use in order to last longer in this market. Okay, so let's talk about drawdowns. Here's what we need to know about them. So here I made this chart, and this green line represents our account balance. So let's say on January the 9th, we open up our account and we placed $8,000 in our account. And we have a steady increase, so it looks like that we're doing some scalping because we're making little profits. And on January the 12th, we did really well, and now we have $10,000 in our account. However, we seem to have stumbled onto a losing streak, and we've been making some really bad decisions. However, we're still in the market because even though we've lost $4,000 between the periods of January the 13th and January the 17th, we still have enough in our accounts to make more trades. So we call this $10,000 area the peak, and let's call this the trough. Now, the distance between the peak and the trough, we call that the drawdown. So again, we do have losing streaks. We can't avoid them, but we should already have a plan, and this is part of your trading system, a plan as to what are we going to do when we get into these losing streaks, as they are inevitable. Now, it is impossible to eliminate losses, and I think we've already established that in our minds within the previous videos that we will lose. That's why I keep saying this so many times. However, we can be successful by minimizing the impact of each loss. So don't think about eliminating losses, think about minimizing the impact of the losses so it doesn't hurt our account. Also, with a good trading system, traders have a 70% chance of profitability. 70%, that's a good number. So remember, the more solid our trading system is, the more profitable we will be in this market. Now, having a 70% chance does not mean, mind you, that 7 out of your 10 trades will be successful. It just means that if we open up 100 positions, it's more likely that 70 of them will be profitable if our system is solid. If it's not solid, then that number will be less than 70, maybe even much more less than 70. But 70% can also mean we might have 30 losing trades before we get to our 70 consecutive profitable trades. So also keep that in mind. Okay, so here's a question for you. If you were to have 30 bad trades in a row, would you still have enough money in your capital to enjoy 70 consecutive profitable trades? Because if you don't have enough money in your account balance, then you really should not get involved in this market until you do. So answer this question honestly. If you did have a really long losing streak, if you did lose 30 trades in a row, make sure that we do have enough in our accounts to keep us lasting that long, even though we haven't been profiting. Okay, so let's talk about minimizing losses, as we can't eliminate them. So I'm going to show you two charts right here, okay? The chart on the left shows us what would happen if we risked only 2% of our capital. the chart on the right shows us what would happen if we risked 10% of our capital on every investment. So on the left, let's say we have $20,000 in the Forex market right now, or $20,000 in our account. And let's say we are committed to making 2% investment on every trade. So that means our first trade, we risk $400. Now, the trade turned out to be a loss, so that $400 is lost. That means we are left with $19,600. So when we place a second trade, we should risk $392. And then we lose. And then our third trade, we are left with $19,208, which means when we place a trade, we should only risk $384, no more, because remember, we're only risking 2%, and it goes all the way down to 15. So if we risked 2% of the money we have in our account on every single trade we made, providing that you've plotted your stop loss, because this is what we're talking about, our stop loss, that means after 15 consecutive losses, you will have $15,073 left in your account, which is still a good amount of capital to have. And you can still build a successful strategy with that amount of capital in your account. And hopefully at the end of those 15 losses, you would have accumulated enough knowledge about the mistakes that you made, which is the reason why you lost those 15 investments, to turn that around and create more winning trades. So again, if we risk 2% of our capital, we should still have enough in our account to where we can build a very successful strategy and to make really good profits. Now, on the right, this is what would happen if we risked 10% of our capital. So as you can see, we start off with 20,000, we lose 2,000. Then we have 18,000 in our account, and then we risk 1,800. And as we can see, we continue this pattern all the way down to 4,575. So as we can see, if we risk 10% of our capital on every single trade, and we have losing trade after losing trade after losing trade, that's going to hurt. So we also want to think about reducing the amount of capital that we risk on every trade in order to keep us in the market. Because the longer we're in the market, the more profits that we make. So that's what we're dealing with. We're staying in the market so we can have those opportunities. And if we risk 2%, 15,000 is not a bad amount of money to have that we can use to make big profits. Okay, so again, we're talking about loss of capital and how much it would take for us to get even. So meaning, if we lost 10% of our capital, that means we would need an 11% profit in order to get back what we've lost. So again, we need to make these calculations as I made them on this slide, so we have an understanding as to how much we need to make after we've lost. So let's continue. Let's say we've lost 20% of our capital. If we lost 20% of our capital, that means we need to have a 25% profit in order to wash away that 20% loss. So we also need, and then it keeps going all the way down to 90%. And as we can see, the more we risk, the more we stand to lose. And the more we lose, the bigger our profits, the bigger the profits we need to break even. So it would be more beneficial for us to risk small amounts of capital. Now, if we risked 2% of our capital and we lost that, then we only need just a little bit more than 2% on the next trade to break even. So remember, the smaller you risk, the longer you last. And it would be easier to have a large amount of capital to begin with. That way, your losses will not hurt as much. Okay, so let's talk about the reward to risk ratio, as this is important. It just means here we make one trade, and if we lose $1,000 on the trade, that means on the second trade that we make, we are seeking $3,000. Because if we hit that $3,000, that means we can wash away whatever we lost and still make a decent sized profit. So again, here we're dealing more with stop losses and also our limits to make sure that we get the profits that we need and that we don't lose our profits if we keep our positions open too long. So again, this is what it would look like if we ended up losing $1,000 on one trade and then we open up another trade. Many investors use this formula in order to make sure that not only we have the opportunity to wash away what we've lost, but to also make a profit at the same time. So calculating a good reward to risk ratio that works well within your system would also be beneficial. So think about, in your trading journals, making a chart just like this. Okay? Now, here's some more information about the reward to risk ratio. It's very good for position traders who have the patience to wait for a profit. So again, patience is the key here. And also patience will help you as you're approaching that learning curve. And this doesn't work well with scalpers because they must consider the fact that the initial pips loss in covering the market and reducing position size and widening stop losses can help you use the reward to risk ratio in your favor. So again, we're going back to trading styles. So depending on what type of trader you are and how much of a commitment you're willing to make into this market will determine whether or not the reward to risk ratio is right for you and how to set the right reward to risk ratio. Maybe 3 to 1 is a good ratio, 4 to 1, 5 to 1, 5 to 2, 5 to 3, whatever works for you. Okay, so again, here's what we've learned. We've learned that risk management is the difference between life and death. It's very vital because it keeps us in the market, and we've already accepted the fact that we will lose. But the question is, how much are we willing to lose? And if we lose, will it hurt us? And if we lose, how feasible it will be to get back what we lost. And if our trading system is solid enough, we can wash away anything we've lost in the Forex market and at the same time make the profits we need to make in order to become successful Forex investors. Thank you for watching this video and good trading.